You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
We miss you. Monday morning in Paris. Don't I sound like a native?
I heard you say we missed you, and you stuttered.
I did miss you all weekend.
We miss you. That's what I heard.
It's International Week in the basement. That's why Doug's got the funny hat on. It is why OG's wearing his kilt. And man, is it an exciting
Good day, mate.
week.
That's just his Catholic schoolgirl miniskirt, Joe. It's not a kilt.
Oh, just pulling that old thing out again. At the beginning of every week, whether it's International Investing Week like it is here in the basement this week or any other week, we always begin the week by saluting our troops who are true Spartans, true warriors, which, by the way, for people who don't see the video, I got my Sparty mug, which I think is appropriate for this toast. On behalf of the men and women who make Podcast in Mom's Basement, the men and women who serve our troops and their families and our veterans, the people in our military, here's to you. Let's go stack some Benjamins now, shall we?
Thanks, everybody.
How do you say let's go in French?
Vamonos.
Yes.
Close enough.
You beat me to it. Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and if you're thinking more international stocks in your portfolio would look good, we're here to help you start building. On today's deep dive, we'll make the case for global investing, help you find the right investments, and put in just the right amount. And that's not all. One stacker in Cleveland named Jeff said, you know what? I'd better call Saul-Sehy and OG because I'm wondering about how to set deductibles on my insurances. Sure, Jeff.
Insurances, Jeff. You said it wrong.
Can I do my job?
Not well.
Apparently not. If we got to tell you how to pronounce the words.
Let's do that over again. One stacker in Cleveland named Jeff said, you know what? I'd better call Saul-Sehy and OG because I'm wondering about how to set deductibles on my insurances. Sure, Jeff. Nothing lights up these dorks more than insurance discussions. Of course, we'll also light up a great TikTok minute, and I'll whip up some eye-popping trivia. And now, 2 guys who I can assure you are cuckoo for global investing and insurance talk. It's Joe and OG.
Hey there, stackers, and happy Monday. Welcome back to the Stacking Benjamin Show. We're super happy you're here. And we are all about international investing today. And the guy that we call the international man of mystery, it's Mr. OG. I need to say that without laughing.
Yeah, nobody says that.
Yeah. Not heard that anywhere ever.
Never? You're not an international man of mystery? Did you have a good weekend, OG?
Yeah, I mean, it's summertime, so you can not have good weekends. There's only like 12 of them, so you better make do.
Nothing better in Texas than sitting out and watching sweat drip off every part of your body all summer long.
It doesn't bother me, though. I like warm weather, so play golf. You hit the golf ball super far. You play in the morning. You do a little, sit in the pool. Have a little margie.
We had some fun after we recorded on Friday, and that was, guys, this was great news. They're doing some work on the back of my house and got some great news from my builder. They discovered where the water main is that comes into my house on Friday. And they did it the hard way.
You know, there's a 3-digit number you can call that you're supposed to call before you do any sort of work outside.
Welcome to Texarkana.
I'm no expert in building code.
However, we got a great show today. We are going to be talking international investing all week long. So if you're one of those people that I keep seeing online who are like, you know what, I got a little complacent and I didn't build international out in my portfolio, we're going to talk about why you should. We're going to talk about the risks involved. We're going to talk about the types of investments to use. And on Wednesday, Joy Yang from Market Vectors ETFs is going to join us. And she's going to talk about how they look at international investments. So we got the pros coming in as well, OG. Super fun week here in Mom's Basement. Before we get to that, we've got a couple sponsors who make sure that we can keep on keeping on and you don't pay anything for any of this goodness. So we're going to hear from them and then international investing in the spotlight on a Monday. You may not know that when we started Stacking Benjamins, it was a blog. And even then, just the startup cost, I remember thinking, is this the right thing? And what if I write things and nobody comes, right? Well, luckily, that didn't end up happening. But starting something new isn't just hard. It's terrifying. There's so much work. You're not sure whether it's going to work out. You're not sure if anybody's going to read it. And then we change it to a podcast. Is anybody actually going to listen, right? What if nobody wants all the stuff that we have? Well, had I used Shopify, it would have been even easier because with their expertise, their helpful tools, and their easy to use platform, that's something that would have made Stacking Benjamins more effective much, much more quickly. Shopify is the commerce platform behind millions of businesses around the world and 10% of all e-commerce in the U.S. Names you've heard of like Heinz and Mattel, Shopify, Gymshark, Aviator Nation, Allbirds, also all Shopify. Get started with your own design studio with hundreds of ready-to-use templates. Shopify helps you build a beautiful online store that matches your brand style. And best yet, Shopify is your commerce expert with world-class expertise in everything from managing inventory to international shipping to processing returns and beyond. And did I mention that iconic purple Shop Pay button? It's used by millions of businesses around the world. It's why Shopify has the best converting checkout on the planet. It also helps boost conversions, meaning less carts going abandoned and more sales for you. So you're stacking Benjamins much more quickly. Time to turn those what ifs into with Shopify today. Sign up for your $1 per month trial today at shopify.com/SB. Go to shopify.com/SB. That's shopify.com/SB. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. Built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you. Well, let's begin our deep dive by making the case for international investing and really the state of international investing. I know that for the last 10 years, OG, international has not been the place that you've wanted to be, frankly. However, when we look at longer periods of time, and I'll get back to this, it paints a much, much different story when it comes to investing internationally. And if we look just at the state of the world this year, we're recording this a little bit early because of my travel schedule, but a site called justetf.com updates every day on what different economies are doing their ETFs. Number one ETF in the world as of our recording day, OG, is, want to guess?
Nope.
Poland. Nope. Poland is up a third, almost exactly a third, 33.32%. Greece is number two at 26.62.
You say number one ETF. What you mean is number one country based.
Number one country.
ETF.
Yeah. Right.
Yeah.
The number one economy, their ETF that tracks their economy. So if
Gotcha.
you had just invested all your money in Poland, you would have been up a third this year with all your money. Greece up 26.6, Austria up 23.7, Spain 21.6, Italy 19. The worst countries, by the way, Turkey down 16, Thailand down 12.5, Indonesia down 11, Pakistan down 8.5, Saudi Arabia down 8.3. World investing, OG, all over the map. But certainly, I mean, what we're seeing here, right, is just classic diversification where the U.S. is somewhere in the middle.
Yeah. I don't know what else to say about that. Correct.
I'll keep going with the statistics then, because I also found this interesting from Morningstar. This is a piece from John Reckenthaler. And John broke down the world into two different parts. He took 1900 to 1950, and then he took 1901 to 1949, and then he took 1950 to the present. And he says the cause for the division should be apparent. First half of the century, the 1900s, 2 world wars and a global depression. More recently, no world wars. Also, not such a steep economic downturn like we had then. So you would expect that the sharpest declines would have occurred during those first 50 years. So he looked at bonds and he looked at stocks, and he took $1,000. And when he looked at the worst 10-year periods during each of those 50-year periods before 1950, your bonds, OG, in the US, your worst 10-year return would have taken you from $1,000 up $566. So to 1566. Your international bonds would have only made $193 over a 10-year period. Just absolutely horrible. Stocks in their worst 10-year period, much better, up $670 for the US, only up $341. So during a time of global turmoil, during the early periods of the 1900s, you had the globe doing worse than just investing in the US. But you turn that around, and since 1950, the worst 10 years for bonds, up 577 in the US, up 815 outside the US. The worst 10 years for stocks, up $655 for US stocks, up 886. Clearly, from 1950 till now, using 10 years as a time frame, in any 10-year time frame, you had been better off investing internationally. During the worst time since 1950, take the worst 10 years, you were better off being international than you were being in the US. So just from a risk mitigation standpoint, OG, where we think international is riskier, it turns out that at least for the last, 75 years, being international might have helped save your bacon, like it is for a lot of investors right now in 2025. And again, because we're recording a little bit early as we record this, the US market just getting back to zero, the S&P 500 just closing in on zero, almost halfway through the year. And we made it back, OG.
Made it back to even. Ultimately, if you believe that diversification helps, and you believe that markets are efficient, and you believe that you can't have any sort of guesstimation on what stocks are going to do well, what companies are going to do well, if all of that is true, why do you only believe that with companies that are in the United States? Why would you only believe that with tech companies if you only invest in the NASDAQ? You know what I mean? Like, why wouldn't that also be true in other economies and also in other marketplaces and other periods of time? So it stands to reason that as you evaluate your asset allocation, that companies that are based in other parts of the world also have good times and not so good times. And also the economies in those other parts of the world have good times and not so good times. And sometimes those are synced up with other countries. You think of maybe Europe, or you think of the Pacific, or you think of the Americas kind of moving lockstep. And that somewhat makes sense, right? I mean, if the US is going down, it makes sense that you would also argue maybe Canada and Mexico, because we're such close proximity to one another, there might be some similar things going on. But by the same token, you just can't guess on that. There's no alpha, right? There's no benefit to trying to guess on it versus having some in everything. It just makes more sense. The question, of course, is how do you pick that number, and how much international What percentage should you have in your portfolio?
Yeah, and I'm thinking that is where this all leads ultimately. But one thing you talked about, we began by talking about diversification. I mean, look at all these different markets that we talked about and having some in different places. But also, OG, another thing you touched on that I really think we should go a little deeper on is correlation benefits. I mean, there is a benefit to having assets that aren't correlated. I mean, the fact that, the Poland economy may be doing something different right now than is happening in the US economy, than is happening in Indonesia. Like, that's a huge benefit for people, especially people who think that the stock market is risky. I'm sure, hear this all the time. I hear it from people when I go around the country. The stock market is kind of risky. What do you do? Oh, yeah, you have a financial podcast? I don't do the stock market. It's risky. Well, I think one of the best ways to mitigate that risk is by getting rid of correlating assets, right?
Yeah. And what you're talking about here is how likely is something, but two things, to do the same thing at the same time. For example, in the US, if you look at small companies and medium-sized companies, there's no benefit to the diversification of medium or small. They're highly correlated, which means that if one goes up, the other one's going to go up about the same. One goes down, the other one's going to go down about the same. Whereas big companies versus small companies aren't nearly as correlated. So there's no guarantee that if big companies go up, small companies are going to go up. They're going to have their own wavelength as you think about it. And the further away you get, if you think about Poland in the US, they're going to be much less correlated. So it does its thing. We do our thing. Sometimes we're going to ride the same wave, and sometimes we're going to be completely opposite, kind of like what you're seeing right now. And that's a benefit for investors two ways. Number one, from a savings standpoint, you're automatically buying the lowest thing as you're investing, right? You don't have to try to time that out, because some of your money is going to the thing that's not as good as the other things. The other benefit is you always get all the return. It just comes in a random order. So you don't have to try to figure out when is Poland going to take off, because you have it. You don't care. It's just you get it when it happens, like everybody else should. And if you're already retired or you're not saving any more money, right? You have your portfolio and now you're living on it. It provides an automatic diversification benefit, because it's going to provide rebalancing opportunities where the US has been doing well. Cool. I can take some of that profit, reinvest it into the areas that haven't been doing as well. US does well again, take some of that profit, reinvest it. Now, this whole time I'm buying more Poland, using your example, at lower and lower prices. And then all of a sudden, 1 year, all that stuff that you bought at those cheap prices is up 30% in 5 months.
I don't think we've had any stackers ask. I can almost safely bet there's nobody in our audience who's gone, I wonder when the Poland economy's taken off. Yeah. Sitting in their backyard going,
come on, Poland.
Let's go.
Come on, Warsaw.
Let's
do it.
Yeah. And there's also upside, right? Like, you can't predict when things are going to go up, but also just looking at the way that our economy is so global now. I mean, think about when you and I were young and the economy in India versus, OG, the economy in India now, or the economy in Africa versus some of the exciting things going on in banking and technology, payments. The speed of money with banking in Africa is just absolutely amazing. I mean, I got a letter recently from an African prince who told me that he just needed a little help.
You get a lot of those letters. You're connected, man.
It's incredible.
Well, and if you think, I think maybe big picture here, if you believe that part of the growth of the US's market has to do with the increased economic worth of the average person in America over the last 50 years, let's say. If you think that some of that is tied to that, and then you look at some of the developing countries, you look at India, you look at Pakistan, you look at Africa, and you say, how many people in those countries don't even have cell phones yet? Are at the spot from an economic perspective of the 1950s of the US, right? Not everybody had a TV. Now we have 3 of them. Not everybody had a phone in their house, and now we have 5 telephones in our house. You know what I mean? It's like, if you think that that was part of the cause, or I don't know, result, I'm not sure. But if you believe that that was part of the growth trajectory of the United States, and then you look at those other economies and you go, they also have to go through that whole thing, but they have 3 times the people.
Right.
You know what I mean?
Yeah.
India has what, 1 billion people. Pakistan has hundreds of millions. You know what I mean? Africa, the whole continent's bigger than the United States. So Americans are kind of a little sheltered, right? I feel like. And you go like, oh, that small place over there of Africa. It's like, no, that's the size of everything over here. Like America, Mexico, South America. It's like, it's a huge continent that's full of billions and billions of people. And a bunch of them still are lower, like poor. That whole rising middle class hasn't happened there yet. So why wouldn't you want to, if you knew what happened in the US, why, and you go, well, that's part of that. Why wouldn't you want to invest in other areas that are about to do the same thing or potentially? So,
and that growth, of course, is going to come in waves. It's not going to be even, which brings up, I think, the next point. There's 2 different opportunities here. When people think international, they think one opportunity, or they think a bajillion ones, like we mentioned, Poland and Turkey and, the continent of Africa or all these different things. Truly, you can break this down, and experts do, into 2 different opportunities, which are developed markets and emerging markets. And for people who are new to this investing game, OG, can you talk about the different opportunities that means that those 2 are, and how to differentiate one from the other?
Well, in my mind, emerging market countries are countries that you would say are up and coming. Like one of those, like some of the things that we talked about, some countries in Africa or some countries in the Middle East or some countries in the Pacific.
I think they even still call Poland an emerging market.
Yeah,
I believe.
Good. Yeah.
I mentioned earlier that sometimes people think investing in international stocks is risky. So let's talk about the different risks, OG. I mean, there's a few big ones. Political risk. If we're going to invest in just one economy, you might have things happen politically in that country that are going to change the game, which brings up another one.
It's just going on in Turkey right now.
Oh, good point. Yeah. Which brings up the second point, regulatory differences, right? They might go, yeah, international investors can't do X, so they can't do Y. So
the reporting requirements are different. There's all manner of differences in the security of the information, the security of the securities, frankly, the hierarchy of the structure of who owns what and what happens if things don't go your way. Those are all parts of the risk factor associated with it.
And then another risk is, of course, currency risk. I mean, I remember right after Operation Desert Storm, there were some investors that I knew in Detroit that were buying up Iraqi money, thinking it was coming back, right?
Mm-hmm.
When this thing comes back, it's going to be great. They're going to have to bring it back. We're going to make a ton of money. I mean, that obviously is a huge risk. That risk didn't play out the way those people thought that it was going to play out, which is funny. I need to call those people and say, I told you so.
Probably not.
But I won't do it. I'll just do it on our podcast instead. Not only that, you also have fluctuation between the dollar and that local currency, right? You've got whatever's happening there, and your dollar's worth more, your dollar's worth less, depending on what's going on with that. And I think this brings up a big point. This is why I think I don't want to invest in an individual stock that's just in Poland or just in Turkey or just in Israel. I want to invest in a much, much broader market, I think, because of those challenges. And it's so hard to know sitting here in Texas, what the hell's going on in Turkey. That to me seems to be very dangerous.
Well, I mean, I would go even a step further and say, I don't even know that you want to pick specific countries because, again, unless you're really paying attention, I just look at data, and you can look at the output of the US economy in terms of like how much of the global GDP does it produce. And maybe that's your starting point from an investing standpoint. You'd say like, okay, well, it does 55% of the world's GDP. So I want 55% of my money in the US. Okay. It's a fine starting point. I can't argue with you. Well, how much money should we put in Canada, for example? Well, if you're using the same number, you'd say it's 3%. 3% of the world's GDP is from Canada. I'd say how much should be in China? You go, oh, China. Oh, geez, they're slaying it, right? No, 3%. But we think, because of news and our personal biases and all that, like everything comes from China, right? Like we would think their economy is slaying it. So why wouldn't we have a lot? You know what I mean? So it's really risky to try to put your own psyche into how much should go into Colombia versus Argentina, right? Unless you're doing business there, unless you're very familiar, there's plenty of people who have family and relationships and, they're like, well, I was born and raised in Brazil. Of course I know what's going on. It's like, okay, cool. Well, then use that to your advantage. But for the rest of us mere mortals, I think you can't go wrong with just a regular diversified international holding. In fact, if you wanted to get frisky with it, what you might choose to do is separate it by big companies and small companies. That's what you do in the US, right? So I got my big growth companies and I got my small growth companies. I got my big value companies. I got my small value companies. Why wouldn't you do that internationally? If the US is about 50% of the world's GDP, could you not just say 50-50 if you wanted to? 60-40, 70-30, like pick your number, right? But inside the US, you're going to go big and small. Why wouldn't you go big and small outside of the US?
Are you to some degree, though, doing that if you go developed countries and emerging markets? Because emerging markets are going to also be smaller up and coming stocks,
potentially,
I would think, in
but
those.
So yes, I would submit to you that back to your second point about correlation, I'm going to have emerging markets separate than developed market. The way that I think about it is developed market is big and small, emerging market,
Big and small.
if you can get it, but probably emerging market is separate.
I would think there would be even a higher risk multiplier on a small company in an emerging market than there would be in a developing country or a undeveloped country.
Yeah, I mean, the factors of small versus big are true irrespective of location or time.
But I would think going back to some of those risks, OG, I mean, to Doug's point, I think you probably have more political risk, more currency risk, regulatory risk with some of these developing countries.
I'm supporting what Doug's saying. I'm saying there is a higher risk premium, risk adjusted return expectation. If you could specify emerging market small,
Right.
it would provide a greater return expectation than emerging market large. Yes, I would support that. But now you're talking about like percent. It's like, how much, like, do I want that to be 2% of my portfolio? Right. And I've got $1 million. So we're talking about a $20,000 fund. Or do I have $100,000? We're talking about 2% of my portfolio. That's a $2,000 position. You know what I mean? Like, you also need to consider that, obviously.
I want to address that question in a second, but there's a burning question that I know that a lot of our stackers have, which is, okay, if I'm not going to buy the individual stock, I'm not going to buy an individual country, their market, like you buy the S&P 500, right?
Mm-hmm.
How do we buy it? I mean, you've got all these different ways to buy things. You could do an ADR, you could do exchange traded funds, you could buy mutual funds, you could do direct investments, you can go active managers because of the additional risk internationally, have managers like, Templeton historically is a company that was great at picking international investments. Active versus passive. Can we talk about ADR, ETF, mutual fund, direct investment? Like, what's the best way for a beginner to get into these things?
I mean, any of those would be fine. What you're talking about is fundamentally, do we want to own an individual position or do we want to own a basket? The way my brain works is I just kind of think of it like a flow chart, yes or no. Like these are the break points. Yeah. And then
should I get Taco Bell tonight or shouldn't I?
Yeah. It's not even that. It's more like, should I get Taco Bell or should I have KFC? If KFC, do I go with the 20 piece or the 15?
What's your cholesterol level currently?
Exactly.
Is this like a Venn diagram though, where there's an intersection? Why not both?
Why not both?
And now you can with Taco Bell's new nuggets.
Yes, indeed. But Taco Bell's nuggets are breaded in tortillas.
Tortilla chips, which is weird.
Taco Bell, if you'd like to sponsor the show.
Yeah.
We're doing you so.
Not that I've had any.
Rumor has it, right.
Anyway, so on your international side, you're going, do I want to own a basket of stuff or do I want to pick my stuff individually? I pick basket. To your point, I'm not going to figure out, have the time, energy, or effort, or expertise, or interest, frankly, in trying to decide which tech company in Poland is the one.
Yeah, which company's lighting it up in Warsaw.
Yeah, it's just not going to happen. All right. So number two then, all right, so we're going to go basket. Now, do I want active or passive? Don't care. Doesn't matter. It's hard to have outperformance repeatedly. That doesn't mean it doesn't happen. It's hard to predict it in advance. By hard, I mean it's non-existent. You can't do it. But I can't prove to you that it's not going to happen. So Joe likes Franklin Templeton because they historically have done well because they have active managers. And there's a case for that, right? There's somebody on the ground in this small country that goes, no, this is the one we want to buy. Trust me, I'm right next door. They're killing it. I watch the commercials on TV, right? Passive investors say, I don't want to play that game. There's no wrong or right way to do this. So I pick passive. That's just what I pick. So I've got basket of things, I'm going to go passive. And then that really narrows it down to, now do I just want to go individual countries or just lump it all together and say international? I'm going to pick international. I'm going to make the diversification decision, back to what I talked about before, on the things that I know have been proven to make a difference. Big versus small, growth versus value. That's what makes the difference in long-term performance. So I want to have some consideration over that. I don't care about the consideration of which company in Argentina is going to beat which company in Poland. That's not a game I can play.
And I'm with you. I know we mentioned Templeton as active managers. For me, though, I definitely agree. In my portfolio, it's passive. I just don't want to play that game of who's going to have the hot hand tomorrow, regardless who had the hot hand yesterday. Not a game that I need to play either. Which gets to your question then, OG. So how do we then think about this in terms of portfolio percentage? You know, do we do the 50-50 thing like you're talking about? Over the last 10 years, we got smoked on 50-50. Over the last 50 years, we're looking pretty good, mostly because of the fact that during those early years,
yeah, from 50 to 80, it was great.
Yeah, international got a huge head start, got just a monster head start. Yeah. So they could give some back. So longer term, I think you're good. But, you know, if we look at the short term, that would have been a miserable place to be. How do we figure out what our allocation is to international?
Again, I can't say that there's a right or wrong way to do it. If you look at the expected return of the U.S. versus the expected return of non-U.S. positions, I think those numbers vary. I think that the correlation of those things are different. And it boils down to, what is the return that you need in your portfolio to make it happen? If your financial plan says, I need 12% a year to make my financial goals work, you're not going to have any developed market. You're going all small U.S. and emerging market. Like those are the only things that fit.
Because that would be a super aggressive choice, right? That's what you're saying.
Because those are the only investments that historically have produced that level of return. If your portfolio says, you know, you need 6.5, then you're going to be okay with a little less return for a little bit more stability. That's the trade. I think a good starting point is 50-50, or maybe more 60-40. And then I think you ratchet it up or down from there. I can say that we're probably more 75-25 US, because I recognize the home bias, right?
Yeah.
It's very difficult to, you know, lose week after week, month after month, year after year for 10 years and not want to make a radical change. And from a behavioral standpoint, I want to make sure that you're, from an investing perspective, in the ballpark, so that you stay the course. If you're moving from Poland to US to Argentina to, you know, if you're bouncing around trying to find it because you're not happy with what's happening, or you don't think it's working in your plan, then you're going to be making a bunch of changes, and those changes are going to end up probably costing you in the long run. I'd rather have something that's less likely to, you know, shoot the lights out, but still going to make the plan work. So I think it's fine to start, you know, do the portfolio visualizer thing at 50-50 and see what happens. See what happens at 60-40. See what happens at 70-30. See what happens at 80-20, US versus non-US.
Generally speaking, when we talk about volatility, how does international developed market volatility compare to US volatility? Like if we talk standard deviation, should we expect a little more bumpiness in that ride or less, or
I think it's
similar?
About the same.
It's about the same.
It's about the same.
Mm-hmm.
It's just, it has a lower historical return. So the waviness is different.
Well, and that's the key, right? Is that as long as those bounces, that volatility doesn't match up with the U.S., that's part of the win. That's part of what we want, is to have things that will bounce up and bounce down at different times.
I still think it's great, though. I mean, the reality is it's almost always all green. You know what I mean? This is a little book that we have. It's called a matrix book, and it's hard to read. This column here, I'm showing this to Joe on the screen. It shows a column. It goes from 1970 to present. And so every year it's tracking the return for the year and then the average return every year behind it. And so all you can see is just lots of
It's almost
green.
all green.
Yeah. There's a little bit of red in the short run, right? Like little periods of time where a 1-year period or 2-year period or 3-year period would be red. But the vast majority of the time it's green. And you can look at this. You can look at the S&P. You look at big companies, small companies. The overarching thing with investments is Once you pick it, freaking don't touch it. That's the key. You just have to be okay. There is no wrong answer to this.
That's why at the beginning of this year, we did the roundtable. Is it time to ditch your international investments? Because you and I both thought it was ridiculous to do that at the start of the year. It definitely proving to have been ridiculous if you bounced out of international at the beginning of this year. What a horrible time to have done that. At the very least, when I use Portfolio Visualizer, I will set a minimum. And this, by the way, is an arbitrary number, and I'll admit that, but it's arbitrary based on 30 years of experience. 15% minimum international, 5% minimum emerging markets, and then work up from there. But I peg those minimums in there to make sure that I get some exposure to international and then move up. And really, I like what you're saying, starting at 50-50, why not 50-50, and ask that question and then work your way down to whatever works for your goal. And that volatility measure should be based on how close your goal is, I think, OG, right? Mm-hmm. I mean, you're going to look for more volatility, which means skew more toward emerging markets if your goal is further away. And if your goal is closer, well, then I'm going to play it closer to the vest because the goal is to have the money available when you need it.
Joe, in the intro, we said that we were going to tell our listeners how to put in just the right amount. So I don't know why we're not getting straight to this. It's $8,745. I mean, I don't know why it's taking you guys so long to get to that.
I know, right? Why not? The right amount is definitely based on that goal or 8,742.
Whichever is greater.
Well, that's our deep dive. We're going to go even deeper, guys. On Wednesday, Joy Yang from Market Vectors ETF is going to join us. She's going to dive even further into international investing. Can't wait to talk to somebody who is on top of this every day in the ETF markets. So tune in for that show. But also in our newsletter, the 201, we're going to dive even deeper. Kevin Bailey will take you on a ride through some of the best stuff on the internet on this topic. So if you want to dive even deeper than we did today, we're going to take you there. Of course, we'll have links to the places that I talked about today. This Morningstar piece about volatility, the justetf.com piece about ETFs around the world and where they're at currently. We'll have those and more in our show notes at stackingbenjamins.com. So a lot of resources to get your investing game on the international front working. We got a question in the second half of today's show from Jeff in Cleveland. We want to answer that and our amazing TikTok minute. But before all that, of course, the highlight of the podcast.
Me.
Doug's trivia.
Oh. Finally said it. Hey there, stackers. I'm Joe's mom's neighbor, Doug, and all this talk of international investing makes me hungry. Hungry for some trivia. How about this one? On today's date, way back in 1886, Grover Cleveland married Miss Frances Folsom in the White House. Yes, Frances would go on to inspire the great Johnny Cash song, and Grover would go on to play a character on the Muppets. What do you mean none of that's true? Why else would they have made Grover blue? Jeez. Cleveland was a spry 49 years old and only the second U.S. president to wed while in office, and was the only president to actually get married in the White House. Their first child was born a few years later and became a national sensation, ultimately inspiring the Curtis Candy Company to rename their candy cake bar after the young Cleveland. What was the name of the new candy bar? I'll be back right after I go clean out the kiddie pool. I think one of the neighbor kids, well, they did what kids do in kiddie pools.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
You didn't start a business just to keep the lights on. You're here to sell more today than yesterday. You're here to win. Lucky for you, Shopify built the best converting checkout on the planet. Like the just one tapping, ridiculously fast acting, sky-high sales stacking, champion of checkouts. That's the good stuff right there. So if your business is in it to win it, win with Shopify. Start your free trial today at shopify.com/win.
Did you know Fast Growing Trees is America's largest and most trusted online nursery with thousands of trees and plants and over 2 million happy customers? Whether you're planting fruit trees, adding privacy, brightening things up with flowers, or bringing in house plants, Fast Growing Trees has it all. Even better, they can help you find options that are right for your climate, your space, and lifestyle. Click Order Grow. Every plant arrives healthy with the Alive and Thrive guarantee straight to your door. So if you're ready to get planting, this is the moment. Right now, they have great deals on spring planting essentials, up to half off on select plants. And listeners to our show get 20% off their first purchase when using the code WWO at checkout. That's an additional 20% off. Better plants and better growing at fastgrowingtrees.com using the code WWO at checkout. Fastgrowingtrees.com, code WWO. Now's the perfect time to plant. Let's grow together. Use WWO to save today. Offer is valid for a limited time. Terms and conditions apply. Go to growingfasttrees.com for details.
Hey there, stackers. I'm pool cleaner and guy who now needs a Snickers, Joe's mom's neighbor, Doug. This is quite a story. Grover Cleveland's daughter inspired a new candy bar. Interestingly, she shared a name with another person who was a huge star at the same time, a star who would have surely demanded compensation if this candy bar had been named after him. His name was Babe Ruth, but the Curtis Candy Company assured everyone that the fecally shaped bar was named after the daughter of Grover and Francis's new baby, Baby Ruth Cleveland. That is some business savvy right there. And now back to the two sluggers running this podcast. Hey, little sluggers. It's Joe and OG.
What do you think the chances are with Babe Ruth being the superstar that he was, that this was actually named after the baby Cleveland? Like, I think there's like almost 0%
Almost
chance.
0%. The story I heard about this was that Babe Ruth did at least threaten to sue them, or may have actually tried to sue them, and they were able to say no. It was
No.
Brand
You got
new
it all
baby,
wrong.
New baby. Because who wouldn't want to buy a candy bar named after a baby?
Right? Yeah, duh.
Makes total sense.
Of course. I don't know what a big star by all reports, she was a star, but nowhere near Babe Ruth.
Not quite.
No. Good times. What a piece of history there. By the way, who was the first? Did you guys know who the first president was to get married in the White House? Grover Cleveland being the second?
Ooh, that's a great question.
Excuse me, not married in the White House, married in office.
Married in office, right.
Yeah, the only one married in the White House, like you said, Doug, was Grover Cleveland. But the first one to get married while in office.
It's got to be somebody like that, a president nobody thinks of.
Oh,
and one of the
it's
big giant
favorite
fat guys like Howard Taft or something like that.
So close.
Because, he had no pull. That dude had no game at all until he became president. And finally, he's like, I got to become president just so I can get a little action.
And then I could become the president. Then I could become the, commissioner of baseball. Because Taft, long time. No, it was, of course, everybody's favorite, John Tyler. Everybody's
favorite. Are you sure he was a president?
When I think of presidents,
wasn't he the lead singer for Aerosmith?
Just Steven's brother, John, his older brother, John. Steven Tyler, even when Aerosmith was hot back in the 80s, I thought he looked like he was 100 years old.
For sure.
Then, he sounds like it.
He and Keith Richards. I want to see the sales data for Baby Ruth candy bars after the scene in Caddyshack came out, when they found the Baby Ruth at the bottom of the pool. And everybody thought somebody pooped in the pool. Bill Murray's like, it's okay. It's no big deal. And he takes a bite out of it. Sales just plummet.
We had that happen twice at our community pool when I lived near you, Doug. Happened 2 times where somebody threw the Baby Ruth bar in the pool. And I'm fairly certain it was one of the lifeguards that just wanted a break.
How did you know that it was actually a Baby Ruth and not the other thing?
Well, same way. Time for our TikTok Minute. This is the part of the show where we shine a light on a TikTok creator who's either saying something brilliant or air quotes brilliant. Doug, we'll stick with you. What do you think? You think this is going to be brilliant or air quotes brilliant?
No, this is the real deal. I'm sure.
Yeah. Well, OG, you were talking about compounding interest earlier. This woman is going to talk about all the compounding interest you get when you put money into investments.
Saving a quarter a day is $10,000 at the end of the year. Let that sink in.
And then she sits there and goes, duh.
Just let it sink in. I'll wait. I love the attitude
I know.
influencers give.
All you got to do is save a quarter a day, OG, and it's $10,000. That's compounding.
So somehow $91.25 of cash, that compound interest turns that into 10 grand.
Did you do that in your head? Is it really $91?
Well, if you just multiply 365 times 0.25, yeah, you get 91 and some change.
Yeah. Okay. Yeah. I didn't know if you had to use a calculator.
No, we were just thinking, Doug, a lot of people can do that, but you, Doug, like, did you just actually
Who
do
doesn't
that?
get 100x return on their daily investments?
Duh. By putting it in, what was the one Jesse talked about a few weeks ago? Fart coin. Put it all in fart coin. That's the way to go. Let's transition and let's help a stacker in need. Stackers often say, you know what? I better call Saul-Sehy and OG. Lots of times stackers need help with their money. And if you're one of those people, well, call us, stackingbenjamins.com/voicemail. Leave us a short question and we are sure to answer it. Jeff from Cleveland, Ohio is on the line.
Rocks.
Jeff, what's that?
Cleveland rocks.
You can't say Cleveland. You got to say Cleveland rocks.
Yeah.
Every time. In my head, that happens. And is it that bridge? Is it the Guardian Bridge that rocks? That bridge is really cool.
What? Isn't it just like a standard like highway bridge with a little ornamentation on pillars?
Big ornamentation. Those Guardians on the. I mean, they named a baseball team after those. It's super
don't get
cool.
me started on that.
All right, here we go. Jeff, what do you got for us, man?
Hey guys, new to the show and love what I'm hearing so far. I've heard you talk a few times about how the return on your cash or emergency fund can be measured on what you save on insurance premiums. Can you expand on that and discuss how to set your deductibles based on emergency fund status? Thank you.
Jeff, first of all, kudos for pronouncing that word correctly. Good on you. You missed the look in Doug's eye, which is half the fun of being at the card table with him.
Jeff is clearly new to the Stacking Benjamin show because not only did he enrage me on his first try, but he didn't give me my proper kudos.
Which enrages Doug more.
It's an unwritten rule, people. If you're calling into the show, got to give me a little something, something.
Oh, gee, for other people that are new here, let's talk about this. The crappy return on your emergency fund is not that savings account interest rate. It's all the other benefits you get from having that money sitting in the bank.
Well, and I mean, you should be getting 4% on your savings account right now anyway, so that's not zero, but yeah,
Sure.
It's not stock market returns. Having an adequately funded cash reserve or emergency fund allows you to make other choices. It allows you to change your deductible on your car from $500 to $1,000 or from $1,000 to $2,000. On your house, we went from 1% wind and hail to 2% wind and hail. A lot of reason for that was honestly the price was going up on 1%. It just was. It allows you on disability insurance to have a 180-day waiting period.
Yeah, the short-term Aflac Duck insurance, you might be able to say, I don't think I need that.
Yeah, I don't need short-term. I don't need to pay for it. I've got 6 months of cash sitting there. It allows you to make other decisions. And there's not a right or wrong answer on deductibles. I think there's two things that happen in the insurance world. And the first is that you are underinsured for a lot of property stuff because you start with premium, right? It's like, how much can I afford? Therefore, this is how much I can have. And that's a really crappy way to have your house insured. I was talking to my neighbor the other day, and he was talking about how his insurance company wouldn't insure his house for more than a certain amount. You know, we live in Texas. There's a lot of property casualty insurance issues going on here, like in other states. And the company that he's with said, we don't do anything above this amount. And I said, well, but your house is worth 40% more than that. He's like, yeah, but you know, what's the worst that happens? I'm like, well, we live in Texas, man. So I don't know, an EF4 tornado levels the thing. That's probably pretty bad. I don't think we have to worry too much about a hurricane at this point. But, you know, you get hit by lightning, it can burn to the ground. Our neighbors down the street, their Tesla battery blew up in their garage and burned their entire house on the inside. So, yeah, there's lots of stuff that can go wrong. And so he's settling for a lower insured value partially because his company won't insure him for more. And secondly, because the premium would be too much. And I get that. That's like a rock in a hard place. But if you have a good cash reserve, you can help mitigate that maybe a little bit by saying, well, I'll cover the first 10,000 on the house. Therefore, I can keep the premium that's more affordable because I've got an emergency fund. For your car, the default answer for everything is they plug in $500 deductible. Well, maybe you don't need 500. Maybe you can go to 1,000. You know, maybe you can go to 2,000. What does that do to the premium? Does it allow you to have a little bit more coverage in case something bad does happen because you've kept the premium in a more reasonable spot?
You know, the people that I always see that want to raise their deductibles are people that have a tight budget, to your point, OG. And that also is a huge mistake. Frankly, when you start off, you need to cover those risks. And then as you have that emergency fund, you know, there's no such thing as a free lunch. I think a lot of people think, oh, okay, I'm going to get rid of this insurance. Remember that you're taking on the risk. If you get rid of that insurance, it doesn't mean just lower premiums. It means you are shouldering that risk. So realize that that's the case. So look at your driving record before you look at.
Well, I'll add to the car insurance side of it. If you can make the deductible, let's say 2,000 instead of 500, because you're going to cover that 0 to 2,000. That's the risk that you're talking about. And you're in a light fender bender where it's $800 to fix. You can pay this out of pocket. Your insurance company doesn't know that you had a fender bender, and your premiums don't go up next review cycle. You know what I mean? Like there's other secondary effects that even happen because of this versus, you know, going like, oh, well, my deductible is 500. This is $1,000 bill. Of course, I'm going to pay 500 and have them pay 500, not me pay the all 1,000. Then finding out 6 months later that they dropped you, or finding out 6 months later that they went, oh, your premium was $2,000 a year. Now it's 4,000, you know, because you had a claim, you know, or whatever. So yeah, the risk doesn't go away. The risk stays the same. It's just who's paying the risk.
Yeah. So I think, Jeff, to answer your question, really the guardrails that we're talking about is if you're first starting out and you don't have much of an emergency fund, deductibles should probably remain low. It's when they get bigger, you then ask yourself that question. How much of this risk do I want to shoulder? And frankly, OG, in a lot of cases, like what's the bang for my buck? I know for some people, when we just got done doing our success sessions classes, going over my book that just ended a few weeks ago, all of our participants go and they check, if I change my deductible, what will the price difference be? And for some of our students, it was a big difference. For other students, because they live in a different area or they have
maybe it's not as much.
Kids driving. Yeah, the juice wasn't worth the squeeze. Like, why would I not give that risk to the insurance company and pay the extra $100 or $200? The savings didn't make a lot of sense. Jeff, thanks a ton for the question. If you've got a question for us, stackingbenjamins.com/voicemail. One of my, they're all favorites. I've had a lot of fun in Boston, but because I have family in Ohio, Jeff, come to Cleveland at least a couple times a year. We have meetups. So hopefully pretty soon. I know I'm going in July, and we'll see if we can do a Cleveland meetup when I come in July. That kind of gets us out into the back porch territory where we have our community time, talk about stackers doing some fun stuff. I want to say a big thank you to everybody in Boston who hung out with me. It was super fun. Love seeing stackers, getting our stacker community together in Boston or wherever I travel. Thanks for hanging out with me, Boston. Great time. My daughter graduated, guys. She has her master's now. Congratulations to Autumn. And also to my niece, Saffron, who also just graduated from high school. OG, you've got one now that is graduated from high school.
Mm-hmm.
And my friend Troy's daughter, lots of graduations. Yeah. I feel like
I just graduated to a big kid bed.
Good job doing the thing that everyone largely expected you to do.
Right.
Doug finally was able to get rid of the plastic mattress cover.
Yes. It's been a great spring all around.
I don't pee the bed anymore.
You know, the great thing is they make them less noisy now than they used to. So no one has to know.
Yes. Doug has finally been trained. It's great. What else we got on the back porch, Doug?
Well, we've had some great activity in the basement, our Facebook group. One of the things that I really liked, you put a question out there in the spirit, or maybe it was timely, maybe not in the spirit, but it was a timely question you put out, given all of the graduations that are happening, asking, hey, fellow stackers, what's your best money or career advice for graduates this year? And we got some really good contributions from people, and a lot of people contributed. Andy said, after starting your retirement savings, always live beneath your means, buy as little as possible, let other people be fashion victims. Well, I know Andy, he definitely lets other people be fashion victims.
Wow.
Oh, he totally deserved that.
Shots fired, Andy.
He says, don't buy a new car. I don't think Andy's bought a shirt since the Clinton administration. Anyway.
Wow.
But we've got some other great stuff here.
What do you say? Don't buy a new car?
He did. He also said, don't buy a new car. And
how many times have you guys known somebody that graduated from college and immediately bought a new car?
This guy
You're
here.
one of them.
I am one of, well, not immediately, but pretty soon. Too soon. Yeah.
I had one of my best friends from college. The day he got his first job, and he got a big boy job, he immediately went and bought a Pontiac Grand Am. That shows how old I am, by the way.
Pontiac Grand Am. Wow. Yeah. Nick wrote in that if your situation allows it, nothing wrong with living at home for a few years. His parents let him.
There's a lot wrong with that.
Oh, geez, kids listen to the show.
Yeah. Dad, how come we didn't listen to the June 2nd episode?
Yeah.
Oh, we didn't have one. There wasn't one.
I like that. Len Penzo talking about that with his kids. You know, it's so hard to get that down payment in Southern California, like depending on where you live.
And it sounds like Nick had a real job. He lived there for 3 years. He was making good money, and he was disciplined about what he did with that money. And I think that's the challenge. A lot of kids who live at home probably aren't as disciplined with their money management because it's easy not to when you're, eating in mom's house. And
yeah, are you wasting time, or do you know why you're there?
Right. So, Nick stocked up on his emergency fund. He maxed out his retirement accounts, paid off student loans, kept a side hustle going. I mean, he was killing it.
Yeah, cool.
And so some great suggestions there. So I hope parents, OG, read this post and got some good ideas. And a great, great friend of the show, Karen, happened to say, be willing to travel with your first job. You get to see really cool places on someone else's dime and hopefully get a per diem. Per diems are not as common as they once used to be, Karen, but it's great advice because a lot of kids are all looking for stay at home, or work remote jobs. But it's a pretty great time in your life to travel and see where all of the best Western hotels are.
My daughter did that out of college. She was a road warrior working in electronic medical records, helping hospitals set those up around the country. So she'd help one set up and then she'd fly to another place. She actually got to go to Ireland as part of that deal.
Yeah,
and
I remember that.
What was really cool when she was in Belfast was that for American Thanksgiving, the hospital actually did a Thanksgiving dinner for her and a few of the other Americans. It was really neat.
But it was all made out of potatoes, right?
It was.
It was like mashed potatoes shaped into a turkey.
That's exactly it. Yeah, a little home cooking in Ireland.
That is cool. On to another post. I just needed to mention, this is a guy who he knows what the rules of the game are. He knows how to play it. James Bosbus said, as a lifelong diehard Red Sox fan, I have to admit neighbor Doug is right. That's it. That's the end of it. I just wanted to say that.
Say what he's right about.
He just put that out there in the universe. Doug's right. Now, he said everybody should go to Fenway once. It is a museum, but you don't need to go twice. And boy, did that
I don't know, man.
That stirred up some emotions online.
My seats the second time I went to Fenway just a couple of weeks ago, way, way, way better than my seats the first. Like once I've been in this museum, I know which parts of the quote museum you shouldn't sit in. But you got so many seats that don't face the field squarely, so many obstructive view seats like the ones I had the first time where water dripped on us.
Water in air quotes.
Yeah. Who knows what was going on in the upper deck that day. All right. Big thanks to everybody for all those tips in our Basement Facebook group for helping each other with better money habits. That's going to do it for today. Doug, you've got it from here, my friend. What are our 3 big takeaways from today's show?
Well, Joe, first, making your portfolio more international, oui, masseuse. Soyez aussi agressif que votre plan l'exige. Nailed it. Second, that horrible interest rate on your high-yield savings account, that's not your ROI. The freedom from worry, ability to be more aggressive with the remainder of your portfolio, and your ability to self-insure are the true return on your emergency fund. But the big lesson? Baby Ruth bars are actually pretty good. And here I thought they were just something you threw into the deep end of the neighborhood pool as a prank. Huh. This show is the property of SB Podcasts, LLC, copyright 2025, and is created by Saul-Sehy. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.